Hi everyone, welcome to today's session hosted by Angel One titled How to Identify Multibaggers. We have Mr. Divam Sharma and Sreeram Ramdas from Green Portfolio who will be our speakers today, and the agenda for today's session is to discuss about the small cases which have been launched by Green Portfolio, which is now available on the Angel One platform. In this session, the discussion will be centered around what investors must look for when selecting stocks, and we will hear from Green Portfolio as to how they have managed to identify multi-baggers in their portfolios. To give you a brief introduction of Green Portfolio has been one of the most prominent advisors on the small case platform and have grown in popularity in the recent times. The small cases published by Green Portfolio have managed to generate significant alphas since they have been launched on the platform. In this session, Mr. Divam will be discussing the philosophy behind their small cases which have been designed, the research methodology which is being used, and the performance of their small cases. So without further ado, I would like Mr. Sreeram and Mr. Divam to take over from here.
Thank you. Thank you so much, Pranav. I'd like to thank Small Case and Angel One for getting us onto the platform. Thank you. So today what we'll be looking at is how to identify multi-baggers. Multi-baggers is a word that we see that is very prominent, but you need to understand how to look at those multi-baggers. What makes a stock a real multi-bagger? And this is what we'll be doing today, and talking about the high quality right price, which is focused on identifying these multi-baggers at a very early stage. Now, some of the multi-baggers that we've identified in the last three and a half years, we identified nearly 40 multi-baggers, and most of them are part of the high quality right price portfolio or have been part of the high quality right price portfolio. Today, we want to bring the research and say that, how did we do this? And what were those companies? And in that company, what did we see at that point? And how did we get multi-bagger returns out of it? Now, as a PMS, as a fund house, how do we screen stocks compared to retail investors, compared to other investors? This is how we screen stocks. The most important factor that we look at is not revenues or margins or your other factors. What we look most importantly in a company is the corporate governance. How good is the management? What is the experience that the management brings on? What is its capabilities? And the independent directors, etc., etc. The management is the most core component of when we screen companies. Because if you have a good management, right, doesn't matter if it is COVID 3.0, doesn't matter if it is a new war. If you got the right leadership in place, you can come across all these issues and thrive in the environment. Now, second most important factor is that industry. What industry do they belong to? To be very transparent, in the high quality right price portfolio or the small case portfolio, we are not inclined towards financials. But companies in the chemical space, companies in textile space that is constantly growing, that is seeing capex, that is seeing demand from China, those are the companies that we are more inclined towards. And then we look at quantitative items, like I said, the revenues. How well is the revenues growing? How well are the profits? Are they manageable? Are they sustainable? Things like that, even very important ratios. And what investors need to understand is not every company can be assessed by a PE ratio or a price to cash flow or debt to equity. For different companies, there are different ratios to look at. And business analysis, what does the company that we choose has that the other companies don't in the same industry? That's a very important component to look at. There are two types of companies. If you look at Apple, they're a brand, they're not a commodity. So Apple has something special that the other players don't. I'm saying the iPhone maker. And so what we look at the company, what does our company have that the other company doesn't, and what gives them the edge in the market? And again, feeding on to the first point, management analysis. As a PMS, we talk to the management directly during analyst calls, which is held quarterly. And we understand more of the business. These calls are even open to the retail segment. And we understand what can be understood from the calls, what expectations are the management giving publicly, and then that feeds into our decision-making procedure. And valuations. If we do not see what is a multi-bagger, coming back to the multi-bagger definition, It's a stock that can produce multiple times return. So if it's a 2x, if you invested 100 rupees today and the stock is 200, it's a multi-bagger. So we need to see at least a 2x to 4x opportunities when we identify a company. If we're seeing a 35% growth, or if we're seeing a 50-60% growth, we do not invest in those companies. We need at least that 2x 4x type of returns while investing in a company. And what are the key metrics that we look at? I said the management integrity, and after the screening process is over, getting into the nitty-gritty, this is what we look at. Is the revenues growing? Is the return on equity above 15%? 15 to 20% is a very sweet spot for us to invest in a company. In the operating margins, do they have high fixed cost? Fixed cost is something, doesn't matter what your business is doing. If you're selling or not selling, you're paying that price. You're paying as an expense. So how much is the fixed cost? If a COVID 3.0, COVID 4.0, or another war, another any depression, recession comes your way, will you be able to go forward? Will you be able to sustain? And the tax rate, what the company is paying, the tax rate has to be at least close to the statutory tax rate. And strong balance sheet. If let's say you have a company with very high current assets, obviously it's from when you look at initially, it's a very good thing. But then when you further delve into it, most of it is goodwill, which will not, what goodwill is, it's not going to generate cash for you in the future. So how is the balance sheet structured? Is the balance sheet strong? How much debt have they got? Is the debt higher than the equity? Meaning, is it more than 1x? 1x meaning, is it more than 100%? Because higher the debt, if you look at any companies in the past, it has gone out of business because it doesn't have cash, or the debt has been too low. Debt has been too high. So we look at companies with very low debt or sustainable level of debt. And surely we had companies that had high debt, but those companies had a plan in place to reduce that debt. So what we look at is, let's say I'm a chemical company and I'm seeing demand coming from US, which was earlier going to China. Now I want to increase my facilities. I'm not able to sustain that type of production with the current facilities. So I'm going for further capex. Now, where can I go for capex? Surely I can go to the equity markets, I can go to the debt markets. But if I already have a very high debt, no one is going to give me money. Or when people lend me money, it's going to be at a very high interest rate. So if you have a very low debt to equity, you'll be more favorable and you can easily do capex, you can easily raise money, your credit rating will be better, your interest rate will be lower. And that's a very important factor we look in companies, because there are companies that are trading at, let's say, 4 or 5x PE and that have huge debt of 500%, 600% debt to equity. And retail investors might say, okay, this is trading at very low PE compared to its peers. But you need to look at different side of the story. What is the numbers saying? So that's what I'd like to explain here. And what is the company doing that's different? Is there product innovation? For example, a company that has been doing something that goes into the internal combustion engines, the classical diesel and petrol vehicle cars. They've been producing a single component, but after 10 years, they're coming and saying that, we are going to do electric vehicles, or we're going to do something that will help in, or that can be used in ethanol vehicles, ethanol fuel vehicles. That's a product innovation that they're stepping up. The management is very proactive. They want to seize more opportunities. And that is something that we look at in companies. Or there are special growth triggers. It's a very abstract term, meaning it's not very defined, but I will try to explain it in the next slide. So what are these growth triggers? Now, theme-based. There are different themes in small case. If you look in mutual funds, there are different themes. Small case, there are different themes. So electric vehicle can be a theme, because we know that electric vehicle will be the future, or ethanol, and we are moving away from internal combustion engines, from fossil fuels. So that's a theme. And if a company is inclined towards that theme, we might consider investing in that company, provided that the fundamentals are very strong. Another theme can be ESG, environmental and social governance. And these three factors, if it is there in a company and the company is growing, and ESG is the future as well, because companies that are more more aware about the environment, treating the environment well. We have seen in the past and we will see in the future that those are the companies that will create greater returns than the same company that has a low ESG rating and is operating the same industry. So, and long-term contracts, if let's say a chemical company has got a long-term contract, what does a long-term contract mean? It means stability in revenues, stability in cash flows, stability in increasing, stability in margins. And what does market like? If you look, market likes stability, lesser uncertainty. Companies with lesser uncertainty trade at higher multiples. And change in management. Let's say a management, very traditional management that hasn't been innovating in the last 5-6 years, very lethargic management. Now a new management is coming in place, and they want to take the company into a different area, and they are coming from a background of very high expertise. They have been in the space for a long time, and they're bringing a lot of innovation into the company. And those are the triggers that we look at. And if company is benefiting from government schemes like production linked incentive, PLI schemes, if the company is benefiting from anti-China, so license under government scheme, are they benefiting from that? Have they applied to that? Because if you are in the PLI scheme, we consider it as a very important factor, because you're getting incentives and you're telling the government that yes, I am capable of doing much bigger sales. Because PLI schemes, what it does is it rewards the company, the government rewards the companies by the incremental sales that they bring. And geopolitical development, we saw during trade war, the markets were very depressed from 2018 to 2020. Markets were not moving, it was just consolidating. But there were companies, there were chemical companies, there were amine companies that will be discussed by Mr. Divam, that got benefited from anti-China, because US was having a very hostile take on China, and that demand slowly shifted to India. And so the companies, that's a trigger. If that company is benefiting from geopolitical development, that's a trigger. Tech disruptions, this is similar to the point discussed earlier. This is, we're seeing tech. Tech meaning the electric vehicle is a certain disruption in the market, in the automobile market. Are there any companies that can benefit from this? Let's say semiconductor. We just had an announcement last week that India is now going to leverage semiconductors going forward, and they have a roadmap. But is there any company that can benefit from this change, from semiconductors, that supply these semiconductors or the raw materials for these semiconductors, the silicon for the semiconductors, that are trading at good valuations and have good fundamentals? We in fact identified a company that is in this field, but unfortunately we did not go ahead with this, and we will be discussing why we did not go ahead with this. Debt reduction. If a company is having, let's say, 3x, 300% debt to equity, very high debt. My market cap, it's let's say 1,000 crores, but my debt is 2,000 crores. Initially, an investor might think the debt is too high, because the point I said earlier. But if the company has a plan to reduce the debt and make it more sustainably reduce the debt, that means eventually the risk in the business is reducing. They can go for capex later. But if the plan is there, if the intent is there for the management to reduce debt, we see that as a trigger. And if the company is expanding, when do you do capex? Capex is mostly done 90% of the time. You are doing capital expenditure, or you're buying fixed assets. You're expanding your facility when you think that I have a facility right now, but I'm seeing more demand coming in that my current facility will not be able to cater. This is the case with 100% of the textile companies, pharma companies, and chemical companies that we have in the portfolio. And they're constantly doing capex. It's a very important factor to look at, because when you do capex, you have more demand, that means, and with more demand, more revenues, higher profits, and better margins eventually. Cash utilization. Now, company cash flow is different from earnings. What your income statement say, that might not be the same what cash flow statement says. So we look at operating cash flow. Operating cash flow means I have a primary business. How much is the primary business generating cash? So if my primary business is generating 80 to 90% of the cash my entire business is generating. So let's say I'm generating 100 rupees of cash. In that, my primary business actually generates 90 rupees. That's a very good thing because the major portion is coming from my primary business. Now, what happens to that cash? That's what we look at. Okay, you got good cash. Now, what is that cash being used for? Is the cash being used to just pay the management, meaning the promoters? Is the capex being used for expenditure, meaning, sorry, is the cash being used for buying fixed assets, expanding my capacity? That's a very good thing to look at. So if they're going for capex, that's a very positive item. And let's say they're paying dividends as well to shareholders, they're rewarding shareholders. That's a very positive aspect as well. And are they paying debt with that excess cash? No. Okay. What happens with companies is that they generate a good cash flow. This is the case with chemical companies, pharma companies in our portfolio, and they utilize that for capex. They reinvest in the business, and whatever they have left, they might pay a dividend. The dividend yield might be even 1% or 2%. And then they are not able to pay debt, but still these factors add up for a very good nature of a company. So will we invest? Just looking at these factors, we might consider investing in such a company, considering the other factors are strong. Now, second case, I'm getting good operating cash flow. Am I using it for capex? I'm not utilizing the money for capex. Am I paying dividends? I'm not paying dividends either. Then the question is, what are you doing with the cash? Now, if I'm reducing debt, then that's a good thing. That means the management has a vision in place that my priority right now is to reduce debt. And then when the debt is reduced, I will use the cash and grow my business, etc. A third factor, they're getting good cash flow from operating, they're utilizing for capex, they're not paying dividends, they are not paying debt, and yet it is fine. It is very rare in the market that you find companies that is constantly growing, that is doing capex and paying dividends. So most likely, even if you look at the high quality, right price portfolio, the companies that we choose are the companies that is constantly doing capex, and the dividend yield is very lower compared to other portfolios of ours. But if you look at the high dividend yield portfolio of ours, these are the companies that is generating good cash, utilizing it for capex, meaning they're growing and they're paying dividends. Now, one of the companies that I want to discuss is a company that we were analyzing a month ago, and many retail investors might have invested into this company. Many small investors might have invested into this company, but we did not. And I will give you the reasoning why we did not invest into such a company. So if we look, they're growing EBITDA meaning profit and profit after tax. It was growing. It multiplied actually in the last 3 to 4 years. So which is a very good aspect in a company to see. And this is what we want to see in a company. So EBITDA was good, profit was good, it was growing. You look at margins. This is a company in specialty chemical segment. And if you have margins, EBITDA, operating margins or EBITDA margins above 30-35%, it is considered exceptional. And you cannot ignore the business, because they're certainly doing something the other businesses aren't. And are they doing capex? Yes, the company was doing capex, and the capex spending has actually tripled since 2016. So very good aspects in a company to look at. Now, what really shone for us, the problem with the company was, to feed onto the first point that we made, corporate governance is a very key aspect for us. So when we further analyze the company, when we look into the promoters, corporate governance of a company, and people might ask, how do you assess corporate governance? There is no certain checklist, but you need to see with the current information that you have in the news and in the filing the company has done, you can find about the promoters. And very surface research showcased to us that the company's promoters were involved in illegally getting contracts, indirectly in illegally getting contracts. and which led to CBI investigation and fines and so on, so on and so forth. And secondly, there were transactions that were not disclosed to the SEBI, which comes under insider trading regulations. And this does not reflect good on the management of the company, because leadership, a good leadership has to be there in a company, and that's what matters to us the most. And like I said in the first point itself, it doesn't matter if your company is growing at 100%, if your profits are growing at 100%. If you do not have a good management, we do not invest in that company. And hence, and this company, as a side note, is they produce a certain chemical that is used in the semiconductor industry. And despite it being very attractive, we had to move on, meaning we do not invest in the company because of these reasons. Now, after you identify a multi-bagger, what you should be looking at, how do you deploy capital? Because these most of the multi-baggers are in the small and mid-cap sector, because large caps and more, you have more, the probability of small and mid-caps becoming large caps and blue chips and becoming multi-baggers are greater than large caps and blue chips becoming multi-baggers. So how do you, even after identifying a multi-bagger, how do you allocate capital? This slide shows you how the share price might be volatile. It might be moved 10%, 20% at a time. So instead of going all in at once, you invest a certain amount. Let's say you have 100 units to invest. You invest 30 to 50 units today at time zero. And then you, in 3 months' time, in 4 months' time, you keep doing SIPs and increase your position size. This can be the case with a certain stock. This can be the case with certain portfolio of stocks. For example, a small case portfolio, that you invest a minimum amount in the portfolio today, and then you do SIPs regularly, and then you keep building wealth. Because we have done the math, we have done the science, and if you are someone who is just buying the dips, in 1987, you would have gone bankrupt 3 times. But if you were someone who's doing SIPs every month, you have a certain SIPs that you're doing, then the wealth would have been tremendous. So SIP is always the way. Even if you have a high amount of wealth, invest the minimum amount, then SIP has to match your the wealth and your savings, etc. That's what we personally believe in. Then what's driving the markets? We thought, we're talking multi-baggers today, but we thought something that really relates to current market is there's always news. There's always news in the market. There's so much noise. There's always news in the market that makes people panic. There's always, we say that there is always euphoria, there is always chaos. There's always good news, there is always bad news. And we identified some of the things that are driving the markets. First is interest rates. The Fed is increasing interest rates. What does this mean? Means that a company that has high debt and needs to raise debt, because to service the current debt, etc., and they have to roll over the debt, the interest rate that they pay tomorrow will be very high, which will impact the cash flows, which will impact their future. Now, Chinese shutdown. We know that China is the manufacturing hub of the world. But now the cities that are placed in lockdown accounts for 40% of China's GDP. And when such a large country is locked down, you will there are problems when it comes to the shipping, when it comes to commodity prices, etc. And that is driving the markets too. Russia-Ukraine war, it has been a lingering item for a while now, and this has several effects. For example, on commodity prices, example on trade relationships, for currencies. So there are different things driving the market. So, but should I be like, these things are, so many negativities are there in the markets, so I will not invest today. I will see when these things fade out, then I will invest. That we believe it's not a good idea, because there's always something negative. Even before Russia-Ukraine war, it was the Afghanistan war. Before Afghanistan war, it was COVID, the variant of the COVID. So there's always negativity in the markets. But if you're holding a good stock, if you're holding a good portfolio, then you really have nothing to worry about. If you're worried about these things, that means the underlying, the stocks that you're holding, the portfolio that you're holding is weak. You do not completely trust in it. And hence, there are always there is news, there's always noise. but the real investors are the ones that identify what, okay, Russia, Ukraine, what is happening, but is it changing anything in my company that I'm holding? Is it changing my portfolio that I'm holding? If you ask this question and if the answer is no, then there is no reason why you shouldn't stop investing or you should completely exit the stocks, etc. And hence, SIP is the best way. Markets are ever volatile. There is nothing goes up in a straight line, nothing comes down in a straight line. Everything is zigzag, and hence SIP is the best way. Now, Divam, would you like to take it on from here?
Thank you so much, Sreeram. Hello, everyone. As rightly pointed out by Sreeram, it's all about the company, and noise and broader events will always keep on happening. You have to identify the right investment, and you have to stay invested in a discipline. So today I am going to discuss 3 case studies where we made multi-bagger returns. Balaji Amines is one of them, where we made around 20x returns, and there was a journey. So we invested in this company before COVID, before 2020. This stock, when we invested in, was at around 500 rupees. When COVID came in 2020, the stock went down to around 180 rupees. There we doubled down on our investments because we had a good, like our overall fundamental analysis had pointed out that it's a good stock. We were very confident on the management and overall proposition as a company. And then 2 years down the line, the stock went on to become a 20x for us. So this company is into methylamines, ethylamines, derivatives, specialty chemicals, and excipients. The primary application of these products is into pharma, specialty, into pharma, agrochemicals, explosives, pesticides, etc. So the company has one of the highest capacity into methylamines, which is somewhere around 60% of India's capacity. It is almost a duopolistic market where there are 2 companies. One is alkyl amines, second is Balaji Amines. And when we invested into this company was available at a price to earnings of around 12 times, whereas the price to earnings of alkyl amines was somewhere around 40 times. So both companies had was into a duopolistic market. Balaji Amines was having a higher market share in methylamines, and alkyl amines was having a higher market share in ethylamines. And both had such a difference in terms of the valuation. So when we did a further deep dive, we tried to understand the market. We found that the profit growth in Balaji Amines over the last 10 years was 24%. The sales growth in Balaji Amines over the last 10 years was 14%. The return on equity in Balaji Amines over the last 10 years was 23%. So the company was consistently performing. The management had a good track record of 30 years, delivering good results on an ongoing basis. So this was again a positive. We deep dive, we looked at into the debt. The debt was insignificant, and the company was doing capex on a regular basis. And without taking debt, that means the company was doing capex through internal accruals. If you look at the capacity, they did a greenfield project on 90 acres of land. A part of that land is still unutilized, and they want to do further capex. So when they started this capacity in May 21, they had an overall capacity across products of what 201 k metric ton per annum, and in FY23 they have plans to increase it to 332k mtpa. So the company was doing capex. The company was also an anti-China play, where a lot of products that they made was exactly anti-China and direct China substitutes. And they were gaining traction because China, for some reasons, for environmental reasons, had shut down its plants and was not exporting to rest of the world. And India benefited, and Indian companies, amines companies benefited from this. Now, the company had an overhang of some hotel diversification that they did in 2018, And it was an insignificant expansion, 70 crores, which the company accepted, and they said that, hey, we will not be doing such kind of expansion and we will only be concentrating on our core business. So that was an overhang that was there in the company, which was done away with. If you look at the company, they were also benefiting from PLI. So PLI again was benefiting them. They were entering into specialty chemicals, which is a high margin business. So the company was going into derivatives and specialty chemicals, which were increasing their overall operating margin. The company has leadership, and company is also able to pass on the increase in input cost in terms of its end product prices. So whatever is the rise in my cost of production, I was able to pass on to the end users in terms of the end use price. So considering overall proposition, the growth that the company has delivered in the past, the PLI benefits, the anti-China sentiment, and still it was available at such a low valuation. So we entered into the company, we stayed invested, and as it resulted, over the 3 years investment horizon, we delivered 20x returns on our investment. Another investment which I wanted to talk about is KPR Mills. So now KPR Mills is in the business of textiles. It diversified into the business of sugar, and then since we are all seeing ethanol as a diversification of all sugar companies, the company also diversified into ethanol production. Now the company, what they were doing was they had the manufacturing of yarn, fabrics, and then they were entering the high margin business, which was the garment manufacturing business. Now again, ethanol, having sugar, then manufacturing ethanol again is a high margin than a sugar business. So they were entering and creating capacity in the sugar business. Now if you look at their overall capacity, they increased their capacity over the last 1 year. They increased their capacity from 10,000 TCD of sugar to 20,000 TCD of sugar. They had their backward integration in terms of power manufacturing, where majority of the power is consumed in-house, and then some part of it is also sold out outside the organization, generating additional cash flow. So they had a capacity of around 62 megawatt, and they increased it to around 110 megawatt. If you look at their ethanol capacity, they had ethanol capacity of around 130 KLPD, and they increased it to 360 KLPD. So they tripled their ethanol production capacity. If you look at their historical performance, now again the company was coming from a great historical performance track, where the company delivered around 12% CAGR growth in sales over the last 10 years. The company delivered around 21% CAGR growth in profits over the last 10 years, and the company delivered a return on equity of over 20% over the last 10 years. Now, having a ROE of around 20%, the company intended, and that's what the management said, that they are going to deliver around 40 to 45% ROE over the next few years. And that was because of the expansion and because of the underlying current that the tailwind that the company was seeing. Now, overall, if you look at this business, the company was available at around 10 to 15,000 crores market cap, and it almost doubled for us in 2 years. It is currently at around 21,000 crores market cap. So again, it was a multi-bagger for us, and having done everything, this company was debt free. So if you also look at some other aspects that helped us identify this business, as Green portfolio, we are focusing a lot on PLI, anti-China, China plus one, Atmanirbhar as a theme. Again, this company was benefiting from this theme, as PLI into textile was introduced. The government is very gung-ho about making India a hub and increasing India's market share in textile overall across the world. And government in the recent budget also said that they are going to set up certain mega textile parks where a company like KPR Mill, which is such a big player in this space, is going to benefit. So overall, considering everything, this company had benefited and turned out to be a multi-bagger for us over the last 2 years. Now, another company that I wanted to discuss has been a multi-bagger for us over the last 2 years has been ABB Power. Now, this company came out from as a special situation. This company got listed in 2018. ABB Power was into grid automation, grid integration, high voltage power products, and transformers, and it's a global leader into it. So ABB Power, what they decided was they hyped off this business of power, high voltage transformers, grid automation, grid integration, etc. And that global business was hyped off and put into another entity, which is ABB Power Products. And 80% of this company was sold off to Hitachi. So at the time of listing of this company, Hitachi was available at a price to earnings multiple of somewhere around 70 to 80 times. ABB was available at a price to earnings of around 80 times. And ABB Power Product, when it got listed as a hive off, was trading at somewhere around 25-30 times. So plus, if you look at the business, there were a lot of underlying positives. The debt to equity in the company was almost zero. The company was benefiting from anti-China sentiments, as the government wanted India to be Atmanirbhar in power equipments, and this was a leader in this space, clearly benefiting from this. The company had an order book of around 3,500 crores, which was around 1 to 1.5 years worth of outlook of the company in terms of its revenues. The company, because of the benefits of ABB and Hitachi both being on the cap table, was getting a lot of digitization capabilities. So ABB was already a leader in this space. Hitachi was also bringing in some digitization capabilities. The government wanted its railways to be 100% electrified, and that resulted in continuous order to this company because this is a leader in the space. If you look at renewables, so again, ABB Power Products is a leader in renewables. So a company which is benefiting from the underlying theme, the company which is coming from a good parentage, is available at such reasonable valuations. So we bought this company and we had kept invested in this company, and as it resulted, it gave us around 3x returns in the last 2 years. So again, these are the stocks which I wanted to talk about. So what is high quality right price? So in this small case, we invest in high quality companies. As we discussed, the management has delivered in the past. The management there's no corporate governance issue. And in terms of quality, we also look at the quantitative and qualitative factors, which are positives for the company. So the company should be fundamentally positive, and then we look at the valuations aspect. So a high quality right price, the quality should be good and the valuation should be comfortable. So whatever said and done, if the quality is very good, we should not be overpaying for any asset, right? Like say if we say that 24 karat gold is the best purest form of gold, we should not be paying 1 lakh rupees per 10 grams for 24 karat gold. So valuations is also important. So when we come to valuation, we look at a lot of factors, like we look at price earnings growth, we look at price to earnings, we look at industry comparables. So overall, on an overall basis, the valuations of the company should be comfortable alongside the strong fundamentals of the company. So we buy around 15 to 20 stocks in the portfolio of such companies, with the intent of ensuring that the company multiplies the wealth of investors over the next 3 to 4 years. So what are there in the portfolio? If you look at currently, it is a very well diversified portfolio: pharmaceutical, chemical, power, sugar, textile, steel, cement, ready-made garments. So if you see that underlying theme of what we are following, the Atmanirbhar PLI. So wherever the incumbent companies are benefiting from that import restriction, from that import substitution, and are also benefiting from the export opportunities, the companies are getting incentivized by the government from doing capex, becoming economies of scale type of manufacturers, reducing the cost of operations. These are the type of companies which are going to become multi-bagger opportunities over the next 3 to 4 years, and these are what we are buying in the portfolio. Having said that, if you look at the overall portfolio, the valuations of the portfolio in terms of if you look at the basic valuations, also the price to earnings, price to book value, uh, uh, we are very much comfortable versus the benchmark, which we call as BSE mid cap index. Yes. So the minimum subscription amount is 20,000 rupees in the small case, and the SIP, which Sreeram pointed out, you should be doing SIPs, and the SIP is 5,000 rupees. So we have kept it very simple, and it's a very I think it's a very convenient SIP that we would urge you as investors to do on a regular basis. That will create the maximum wealth for investors, and that's what we have seen. As you can see, over the last 4 years since inception, we have delivered a consistent CAGR, even in the small cases. If you look at over the last 2 years, we have delivered somewhere around 90% CAGR in the last 2 years. And that is consistent. Even if you look at our PMS, we've been consistently delivering over 30% CAGR. So when the benchmarks are have risen at, say, a CAGR of around 15%, we have delivered a CAGR of around 30% over the last 4 years. So the consistency and discipline matters while investing. So if you are buying underlying strong, fundamentally strong stocks at reasonable valuations, and you are looking at investing in a disciplined manner through SIPs for a longer term, you will definitely generate a higher than index returns, and that's what we consistently benchmark ourselves against. We have been consistently delivering an outperformance in a downturn or an upturn on the market. So when the market fall, we will also fall. But we fall lesser than the market. When the market rise, we also rise, but we rise more than the market. So we, on a probability basis, we have been on a consistent basis outperforming on a quarterly basis more than across our products. So this is what I wanted to talk about in terms of our outperformance. So let us also talk about green portfolio at a glance. We manage somewhere around 270 crores in the PMS and around 100 crores assets under advice under small case. We have around 7,200 plus customers in active subscribers to our small case. We have around 100 plus equities which are under our continuous tracking, and we do an initiation report, and we do a quarterly report on all the companies we buy. We do a lot of scuttlebutt. We talk to the management. We talk to industry stakeholders to follow what's happening in the company very closely. We have a team strength of 24 people. We have 12 people in research, and mostly if you look at our team, they are mostly chartered accountants, CFA level 2, level 3, CAs, MBA professionals. I am also a CA and MBA from ISB. My partner Anuj is also a CA and BCom honors from Delhi University. So this is the journey. We began in 20. We took our SEBI license of PMS in 2018. In March 22, in fact, we were the best performing. One of our strategies was the best performing PMS strategy in India across all the strategies. Now, overall, if you look at, we manage somewhere around 370 crores worth of assets under management and assets under advice, and continuously growing. So it has been a great journey for us overall. We have been consistent PMS top performer, managing a large customer base, and very proudly doing so, happy customer base of more than 7,200 clients, top performing PMS, consistently delivering CAGR of around 30% since inception, and we are a leading small case manager. So yeah. So this is about us. We are a SEBI registered PMS and research analyst company. I talked about our team being highly qualified and highly passionate about markets. This is what we cherish about it. If you come to our office, it's all about markets and a lot of passion that we see in each and every team member across. Yeah. So this is me and this is Anuj. We are co-founders in the company, and we did our CA together, CA internship together. We started off discussing markets pretty early in our life. Both of us started investing in the markets when we were 15. We have markets in our blood. I am 2 generations into investing. Anuj is 3 generations into investing. So it's been there. Investing is there in our blood since long now, and that's the passion that we carry in for our investors when we manage their investments. So that's it. Thank you so much to allowing us to present today, and it has been pleasure interacting with you all as always.
Thanks a lot, Divam. So before we actually conclude this session, I have a couple of questions that I would like to pose to you. So generally, when we talk about small cases or small cases which have even been launched by Green Portfolio, so users tend to have a couple of common queries that I would like to maybe segregate and pose to you in this session. So when we talk about Green Portfolio specifically, what we have noticed is quite as you pointed out, you have 7,000 plus a list of clientele. So with this influx of the number of customers continuously increasing, how has your experience with your current investors been so far?
So it's a great question. We love interacting with our customers, and we love taking feedback from our customers. So how we design these products are that they are able to take any number of customers, right? So we design our products where like say even 20,000 customers, 50,000 customers can come in, and all the stocks in the portfolio are liquid. So initially when we started, at least 500 customers initially, I personally interacted with most of the customers and took a lot of feedback in evolving the product, right?
Mm-hmm.
When you go from a PMS to a small case,
Mm-hmm.
there is obviously a different kind of a thought process and a different kind of an expectation when you're going into a technology platform where people are looking at your performance. They are interacting with you through platforms like these, and they are investing with you. You have to deliver that kind of an experience for them, that they are not only making wealth, but they are also satisfied in terms of what they want to know about the product, and in terms of handholding them when the markets are volatile.
Mm-hmm.
So we keep on doing those exercises basis. This is basis learnings that we have derived, that we keep on doing such kind of platform interactions with our investors,
Mm-hmm.
be it through webinars, through AMAs, through written communication, and try to create their thought process in terms of how they should navigate for this wealth creation process. So as a fund manager, we also want to create that discipline that when the tides are turning, we should not be changing our investment thesis quite often. If we are investing, we should be investing for long.
Mm-hmm.
We should be investing in fundamentally strong companies. So then when there is a volatility in the short term because of unrelated events, like Sreeram pointed about, like Ukraine-Russia war,
Mm-hmm.
these will have a short-term impact on the price, but they should not have a long-term impact on the price.
Mm-hmm.
So it has been a fun journey, a lot of interaction, a lot of learning for us, a lot of things that we evolved to actually do a a further level of communication with our investors. Yeah.
Okay, got it. So you were just now talking about how investors have to, stay put in fundamental stocks irrespective of how the market conditions are changing. So with respect to that, I would like to maybe inquire with you if you would be changing your investment philosophy if the broader market conditions start changing over a period of time.
Never. So that's what we try to inculcate in our investors also. Say if I am investing in a stock and due to broader macro events, my underlying and my if my underlying fundamental is not changing, I should not change my decision of investment. Right. Warren Buffett says that if you can't stay invested in a stock for the next 20 years, you should not stay invested for the next 20 minutes. So ideally, I should be investing with a long-term mindset in any company. I should be tracking the fundamentals on a regular basis. If the macros are impacting my fundamentals to such an extent that my overall profitability or business goes for a toss, like say some regulation change happen, which is changing the overall perspective of the business, then I could still consider exiting that or changing my investment thesis for that company. Philosophy, I would never say, I would not suggest that you should change your philosophy quite often. If I as an investor select an investment philosophy, I should be consistent with it. Because if I am changing cues on a consistent basis, I will not be able to make money in markets. There are many ways to make money, but whenever I choose a philosophy, I should stay consistent with it.
Right. Agreed. So my third question would be with respect to basically how the small cases have performed. So what we have seen is a good bull run, and what we have observed is that Green portfolio has managed to do very well in this bull run. So what I would like to maybe try to understand is how your small cases or how your portfolio is expected to perform during turbulent market conditions.
See, during turbulent market conditions, if the overall market falls, the stocks in the small case and the small case overall value will also fall.
Right.
The idea is to what we do is and that's what we do on a regular basis, is that if there is any run up stocks which looks overheated on the valuations, we will exit that. If there is any stock which is changing fundamentals and like if I am buying 20 stocks, like 5-10 stocks will outperform, 5-7 stocks will be average performance, and 2-3 will be negative performance, because we are investing for the next 2-3 years, and during the course of journey, not all stocks, if all 20 stocks perform at a time, it never happens in any portfolio, right? So if I am investing in a portfolio, I have to understand that we are investing for a long term period. So this is what I want to talk about, that if the times are volatile, we will also fall, but we will be falling lesser than the market. One, we are exiting the run-up stocks. We are exiting the fundamental changes, stocks which are changing the fundamentals. Three, on an overall basis, we take a lot of cognizance of the underlying strength of the business, like the debt to equity should be less, the operating margin should be double digits, the management should be good. And if the management is good and it has delivered in the past, if the tides change, the management will be able to navigate the business into a positive direction. So you have to lay you have to give some space to the management also to perform. So if the management has delivered in the past, they will also perform in the future, and that's how we would say that we would outperform. If the market falls, we would outperform on a falling market, as well as if the market grows, we will outperform in a growing market, and that's what we have delivered. But the only thing is that you should keep disciplined. You should stay invested. You should have a 2 to 3 years time horizon, and you should be doing SIPs on a regular basis.
Got it. And one final question from my side is, do you have any plans of launching new small cases in the future?
I believe yes. We are working. we actually believe in a lot in ESG theme. Recently, we have taken the UN PRI membership, and now we are a signatory to UN PRI, which regulates this space globally. And we are continuously evolving this product to give a small and mid cap investment theme for ESG companies. So it is peer-to-peer. ESG is usually peer-to-peer. Say if I am a tech company, I'm usually non-polluting. So my environmental will be high. But versus me and any other tech company, I will do a peer-to-peer analysis that whether I as a tech company versus any other company as a tech company, both how do we stand on ESG parameters. So we are doing a lot of we have created a model and we are doing a lot of hard work to inculcate the ESG parameters across all our companies. And we will be launching an ESG portfolio basis our underlying theme and underlying thought process very soon. Yeah.
Okay. Sure. So I guess that answers most of the questions that I had drafted. So with that said, thanks Divam and thanks Sreeram for taking your time out and coming over to this particular session. And I would also like to thank Angel Broking for hosting this session. And Divam and Sreeram, hope to see you again shortly, maybe in a continuation session for this.
Thank you so much. Thank you.
So thanks. Bye-bye.